Hello and welcome, Alan Uckman, Bullseye Option, with our latest edition of Option Expiration Update. Today is the 18th of May. Quite a week it's been, but I guess it's been quite a month, quite a 6 months, and quite a last couple of years. But the markets continue to go, go, go. We're going to update our positions. We're going to talk about what we're in, what we're looking to get in, and what we've been in. And keep doing what we're doing. With the exception of this unwinding yesterday, we've seen almost a straight up move over the last few months. So let me find a chart here. I'm gonna have to log in, but we all know where the markets come from, and we've got the Nasdaq, the NDX, is up about 15%. Had a little bit of a bounce back today. And it was pressing on, I think it was up 18% before the unwind, so now we're back up 16%. Now that's just in 2017 alone. So these markets have come a long ways. Now we've used the last couple of weeks to take some profits in some positions. We'll get to that in a second. But I wanted to talk today to start with this, the trade from this morning. So let's look at SunPower if we could. SunPower stock, we are buying the $5 call for January. Again, the stock substitution strategy here. And the $5 call, the lowest that this stock has been is just below 5, just below 6 actually. I think 584. If you look at the chart, we've been trading here between 9 and 6 since September, and came up to the 750 level a couple of times. And what's interesting here, a break above the 750 level, which is the halfway point of this range, targets that $9 top again. Now that $9 top is a very modest objective, but if that happens, that option is going to gain in value, 65 or 70%. And if this really breaks out the length of this channel, the $3 of this channel on top of that $9 to $12, then that option will gain 275%. So it's a risk-reward play. And in the context here is solar has been beaten up so badly in the last year or so that it's looking to snap back. Energy markets have come back, and solar is obviously one component. So if we look at something like an FSLR, First Solar, hang on, let me get this box out of the way. The First Solar, they're both positive on the year, but you can see First Solar's had a bigger bounce. It's only down 30%, whereas SPWR is down 50%. And then today bounced back, so we got some good follow through on that, and a push above 750 would confirm this near-term bottoms in place. Then we could see another run. So that's the logic behind SunPower. It's got 250 days at 85 delta. So that's the logic on the SunPower play that we put on today. Actually, if I could here, I want to just make sure this works. Let's see. I'll be putting out this video. This is a video I recorded earlier this week. I recorded Monday, but I didn't pull the trigger on the trade till today. So let me see if this is going to pass through. Since if you can see it on the screen here. Oh, I got to turn this off. So this was from the other day. So Monday, oil market was up.
Recently, and now we're hanging around the 1050 level. Actually, a bit positive on the day, even though the S&P is up there at the high. So we'll have to wait and see how we press below $10 in the next few sessions. But today's VIX option volume.
I'm not sure the sound is coming through, so I'll come back to that anyways. But I'll send that out and post that so everybody can see the logic behind the SunPower video and get a better understanding of what we're trying to accomplish. Again, is be in position, repeatedly be in position with high probability positions for the long term. So also this week, we use that oil rally that I just talked about to exit British Petroleum. So if we look at British Petroleum, when we entered the play back a couple months ago, I guess March 24th, British Petroleum was right at that midpoint of trading, at 36 to 32 midpoint, holding that as a support level. So we leaned on that level, and it did rally above 36, and we used that to take as an opportunity to take profits. Ended up being a 50% profit. Now the lesson we learned there is that you can see it's a pretty modest move from 34 up to 36.5, I guess is where the market was at that time. It's a pretty modest move in the underlying stock. That's a $2.50 move, but it's about an 8% move in the stock, and the option gained 50%. So that's a lesson to be learned there in 2 months in British Petroleum. And also here recently, we had a play in FireEye that we took advantage of here recently. So let me try and find that we exited just the other day. The FireEye trade. Here we go. Here we go. The exit, a 55% profit. Now the lesson to be learned on this one is we got out way, way, way too early. All right, and that's a quote that I keep on my desk to remind myself and remind others that you're never going to buy the low and sell the high. All right, the object here is to take a high probability piece out of the middle, be able to do that consistently and repeatedly over and over, different stocks, different markets, different conditions. But the lesson to be learned here is that the markets can go a lot higher than you think or a lot lower than you think. And the quote that I write and leave on my table was from JP Morgan. He said he made all of his money selling too soon. And we sold way too soon in FireEye. If I can find this, we sold when FireEye had its surprise earnings and was above 14. I think it got to like 14.50. But let's go back to the original trade. The original trade, it formed a double bottom here, and it had been trading between 12 and 14 for a period of time. I'm sorry, 11 and 14. So it targets 17 in an upside breakout, and I was looking to bank some profits sooner as opposed to later because we have a large portfolio right now. And FireEye, which had floundered, and the idea was it was a cyber play, and obviously cyber's come back into the news in a big, big way. So, you saw the earnings surprise and the stock gapped up and it was a 55% winner. We banked it. Now, I don't even want to look and see how high it did get in the last couple of sessions. But if I look at Hot FireEye, it was just in the last few days, I think it was up near that 17 mark that I had talked about. Got up to 16 and some change. So we got out at 14 and a quarter, something like that, left some money on the table. But hey, 55% profit in 2 months, that's what we do here. We've got a whole portfolio of other positions that we're going to evaluate and look at. And, you got to take some off the table, cash some in the bank, and that's what we want to do. So here, looking at the spreadsheet for some of the trades this year, we got out, obviously, we always buy plenty of time, but look in here, got out of the China iShares. It was a June position. Obviously, we could still be in that. Got out of the McDonald's, was a June position. We made 50%. FireEye, we talked about. It was a January position. Still plenty of time, but we're putting it in the bank. That's why we do this. The British Petroleum was 53%. Got out of that. That was also a January position. So you can see we've got a number of open positions now that we want to manage and see how they develop and see where they go from here. So I'm going to go through some of these here in just a second, but I also want to talk about some of the option expiration positions we have because we do have a couple of May plays that are coming off the board with expiration tomorrow. And what do we have here? We had sold the Nugget 750 puts. So let me turn off the audience view for a second here, and I'll come right back. Hang on, let me turn off the sharing, put it on pause. And I wanted to look and see where Nugget is. Now, Nugget had a 4-for-1 reverse split. So that $7 put that we had sold is now, multiply that by 4, our strike price is 28 on that. Okay, so the 28, as long as it's above 28 at expiration for Nugget, then that option expires worthless and we're getting our 5%. So that's what we're looking for now. And then tomorrow's expiration, and obviously we've had a snapback in gold. And so let me get this going again here. Okay. I want to set myself up for screen sharing again. For some reason it's not letting me open this. All right, so it's unpaused. So there you go. Everybody can see. So that's S&P 500. We'll come back to that in a second, do a market evaluation, but I just wanted to finish talking about Nugget. So Nugget's at 34. we effectively now had sold the 28 put that expires tomorrow. So obviously we're going to get to keep that premium. So it's a 5% return on risk in however many days, according to that particular strategy, something we can do on a consistent basis, continue to sell cash secured puts. And until recently, with volatility extremely low, if you noticed, this strategy, I've lightened up on this strategy because when volatility was at 10%, there weren't as many opportunities. There's still opportunities, but what I was waiting for was an increase in vol. Now, I wasn't looking for a explosion in one day like we had, but what's interesting is, as I always talk about, is that when you see a explosion, it's how does the market react afterwards? And here just a month ago, we were up at 16, and very quickly it gapped down and made new lows below 10. So for those long-time subscribers, thank you, number one. And number two, I've been talking about the VIX getting below 10 for probably a couple years. And we've got below 10. If you look at this channel, we broke down below this long-term channel that we traded in. And so now the measured move target is still 9. It got down to 956. But it's an absolute VIX explosion that we had in the last couple of days, that even though here when the stock market was going up and making new highs, the VIX was also rising. So that was an interesting phenomenon, and that was kind of the precursor to there was going to be a little bit of a risk move, and it happened. But now, is it long-standing? That's the question. We have to see where we are in the next couple of weeks and see if we come back down below this old support bottom at 11. Now, today, it got up to 16 and change. It ended up closing, I think, at 1450 or so. So it did back off. It was down about 6% on the day. So I thought that was interesting. But the point is that you don't do the cash secured put strategy when volatility is extremely, extremely low. You're trying to find individual stocks that you can sell some puts on. Now, Nugget's going to be interesting because it's no longer a single-digit stock, and I typically want to do this in single-digit stocks because I know my downside is 0. There's a lot more downside from 34 down to 0 than there was when it was 7 down to 0. So it's all about math. But if we can look at something like GoPro, we had sold a May call against the position that we had that lowered our basis to 850. We sold a $10 call for May, so that's obviously going to expire worthless. GoPro just trading kind of sideways, sideways, sideways. But our basis is at 850, which is only 20 cents away. So even though the market's been going down, which is not necessarily what we want, we're able to sell covered calls against our position every month, lower our basis, and when we do get called out, it will be a healthy return. So we're waiting for volatility to pick up and waiting for the stock to pick up a little bit in Cleveland Cliffs and bounce off that 6 point. So that looks like a pretty solid level of support, which is the midpoint of the $8 to $4 range. So that's where we are with Cleveland Cliffs, and I think we had something else. We had Southwestern Energy, but again, with volatility real low, as it was just until yesterday, it was extremely, extremely, extremely low, that it's hard to use that sort of strategy, either selling covered calls or cash secured puts, when you're not getting enough premium. So we're going to wait for the markets to give us the conditions, the ideal conditions again. But still, even though volatility's picked up and it's at 14.5 or whatever it is, it's still at a historically low level, and it's about unchanged on the year. It has bounced a big deal in percentage terms off that low. Let's look at SPX. Let's look at the S&P. So the S&P today was up about 8 points, but what I wanted to show you about the S&P is, before we go through some of these other positions, is I wanted to show you what it did. Now, this sell-off that we saw yesterday was interesting in the fact that, let me get this out of the way if we could, that what it did was, if you go back to April, let me find this cursor here. If you go back to April, we had a series of lower highs and a series of higher lows, okay? And that was the technical pattern. That's what it was, all right? Let me click on that. Okay, so that was the technical pattern. You don't know what the catalyst is, and we're not in the business of trying to figure out what the catalyst for the market to go up or go down is. But that chart was telling us that we were going to get some sort of breakout from that apex of that triangle. And it just happened to be the market closed on April 21st on a Friday. And then if you remember that Monday, that was after that French election, the first round of the French election, when it was, when it took the concern that the Le Pen party would win. So they took that out, and it turned out to be the normal candidate, and it wasn't going to be another surprise Trump or Brexit populist movement. So when that happened, the market opened up that much higher the next day, that Monday, and never looked back. Now, they always say in this business, for technicians anyways, that gaps are there to be filled, and that's what happened. You look at the low yesterday. The low yesterday in the S&P was 2356, and that was the top of this gap from April 21st to April 24th. So now that's significant. If we can hold that gap on a weekly basis after this backtrack, that's a very positive sign. And I'm still looking for the distance from this high, from 2401, down to this low at 2322. On top of that high, still targets 2475 in the S&P. All right? And for those, again, longtime listeners and subscribers, we've been doing this for years, and every time the market sold off, it's rallied the distance of the sell-off on top of the old highs. Sells off, rallies the distance on top of those old highs. It's done that for years and years and years and years, and it will do it until it doesn't do it. But, like I've said before, and I use this on TV today, Trump didn't make this market. Trump didn't break this market. So whatever nonsense happens, the market itself has very, very solid fundamentals. I mean, we've come a long way in 9 years. We've come a long ways in 9 years, and the fundamentals aren't broken or changing. There may be some short-term turmoil. That's true. But the stock market is a lot different than the economy, and the stock market's a lot different than political policy. The stock market's a reflection of so many things, and corporate earnings are outstanding, record profits, and we're getting record profit. We're getting profit growth, earnings growth. So that's what drives the markets. But that's the broad market, the S&P. We talked about the NDX. The NDX bounced back here today. And let's remember, the all-time highs, the all-time forever, ever highs in tech in the NASDAQ were made on Tuesday. So it's only been 2 days. This was an unwinding that needed to be done. And here you go. Here's one of those breakouts again, and it breaks out to the upside. But look at this run from 4,800 in December, 4,800 to 5,700. I mean, absolutely straight up. And I don't know which stock you want me to look at, but there's so much built up strength. Apple, Facebook. And these are the NASDAQ 100 stocks. Facebook, straight up from 115 to 150. Who else? Google. So the big boys of tech have gone absolutely positively straight up, and some profit taking was warranted. And as I say, it's not necessarily how that markets act on any given day, it's how they react to any unforeseen action, news, events, and see how they follow through or fail to follow through in the sessions after. So if we look at the Dow is still a dog, still has not made new highs, even though the other indexes have. The Dow hasn't made new highs. Still go back to this March 1st, 2169, 21,169, but that's only 3% away. So even though it looks like it's far away, it's only about 3%. So there's still upside potential there in the Dow, and it keeps coming back to this range where we were between 20,250 and 20,750, that sideways range, and now we're kind of stuck in that right now. Today, I think we got just a little bit above it, but ended up closing in the middle of it again. Once again, so a lot of Dow stocks are in our portfolio, and we're going to look for those to come back and continue to participate as a little bit of snap back. But if I look through some of our open positions, January, July, so we got out of British Petroleum, but we still have an Exxon position. So if oil does move up, and oil's it's hit a triple top here in the near term around 49.60 in the front months. If it pushes through there, that's going to 51. Intel is January, and silver is January. GM is September. We're out of British Petroleum. Teva's January. So, all these positions, a lot of these positions have 6 months of time or more. Wells Fargo is a shorter term position, June. Qualcomm's October. The Brazil position is January. The Russell 2000 is July. The Russell 2000 is an interesting actor in the fact that it often overreacts to the upside and the downside, but it came back down inside this channel now, and we needed to get back above 138 again to make another attempt on that 140 because it was nice. It was at 139.25 and it looked like it was going to 140, but now it's backed off some. But anyway, so that's really what we have going right now. A number of good positions, a number of long positions. I remain bullish until proven otherwise. If the market changes, the market changes. But we want to look at things not on a daily basis. We want to look at things on a more bi-weekly basis to see, what the larger overall trends are. And it's about finding value, and I think we do a good job of finding value. And the SunPower trade today is a great example of that value. Finding stocks that maybe haven't participated. I know I did one the other day that I'm looking to maybe look as a new position. Kroger. All right? Kroger's a dog. It's an absolute dog. But that's oftentimes when you want to be looking to be a buyer when something looks its worst, and that stock's just going nowhere between 28 and 30. And one of the trades that I've got a couple of trades that I've missed out on in the last 6 months because I didn't want to be terribly aggressive based on what the market was doing. One is Whole Foods. We've talked about Whole Foods ad nauseum. It had this bottom at 28, bottom at 28, bullish divergence, so many factors. And then when it took off and went above 32, I just left it alone because it was off and running. So now Whole Foods at one time was, and maybe it still is, was viewed as a takeover candidate by Kroger. Now Whole Foods is performing and Kroger's not. So they've kind of shifted as far as stock performance goes. But let's not forget Kroger. And the idea behind Kroger is grocery stores have been consolidating and their margins have been shrinking because there's been a price depression in grocery prices. And so they have less margin, obviously. But they're starting to see a little bit of a grocery inflation coming back, and so that helps margins. That'll help Kroger, and see if they can get a breakout above 30. So that's something I'm keeping an eye on. Another stock that I want to talk about that we missed out on. We've made money in this before, but I did miss out on TWTR, Twitter, UGG, 14. It came down to that 14 level, and it did not make new lows. But you can see how much lower the volatility was than back here. So that was a very positive sign, and now boom, off to the races. Okay, and again, nobody liked Kroger nobody liked Twitter at $14. Nobody liked it. You had this gap up, and it's still. I'm disappointed but it's better to be disappointed about not getting into a trade than be disappointed after getting into a trade. So, we missed out on it. It's just one of those things. But there are always opportunities. And back 3 weeks ago, nobody had anything good things to say about Twitter. And again, the psychology is that's when the risk reward is probably best in your favor. And now Twitter's on the move. It's still got a lot of potential here. Someone can unlock it. Speaking of unlocking, just last week I was on Fox Business. Actually, I was going to be on with Neil Cavuto, I think, with regular Fox, and they wanted to talk about Snap. And I don't see how Snap makes money, and it doesn't make money. It lost $2.2 billion. But as far as an investment, as far as a trade candidate, when this happened here, you could sell the 17 puts for May and take in 75 cents. So you're getting a 6% return on your risk. And if not, you were buying the stock 18% lower than where it was trading. So it's all about the math. It's all about the probability. And then, the actual appearance got canceled for breaking news. Imagine that. Breaking news nonsense. So we never got to talk about it on the air. And then the next day when we were able to talk about it, then you saw Snap up above $21, like right away. It snapped back. So, think about it. Whether a company makes or loses money, a lot of this is about perception, and the sentiment shifted and changed, and people at, $17, Snap's a much better investment than at $23. So I'm not saying this company is going to become the next Facebook, but let's remember Facebook went all the way down to 18 before it figured itself out and figured out how to monetize and figure out how to do the, make money with the online. So look at this. When it was down to 18, nobody liked Facebook. Now it's at 150. All right. So Snap, I don't know if they're ever going to make money. They could just be a unicorn. But from a trading standpoint, they still provide, any stock can provide an opportunity. That's really the message in the lesson we learned, that it's all about probability, and it's all, if you can find a high probability trade and know what your risk is and understand what your chances of success are, there's a way to go after any stock. But I was just amazed that everybody was so negative and say, oh, I told you so, Snap doesn't make money, and the stock sold off. But that was when it looked its absolute worst. That's when it was the best opportunity. So you just never know. A couple of stocks I'm paying attention to right now. I just gave you Kroger. Akamai just made new lows, but we're not making new highs in volatility. Akamai, for whatever reason, sticks in my head because it was what do they do? They were a streaming service to help stream video. And hey, guess what? As you probably know from me, video is an effective way to communicate, and a lot of internet traffic is going to video. Cloud services optimize security, content, business applications, the internet. So they do a lot of video streaming type stuff. So Akamai, it's had a tough time. It was a $72 stock. Now it's down here below this sideways channel it was in for a while. So that might be something to pay attention to. So we'll keep an eye on that. But now that volatility's picked back up, let's see where we are in the next couple of weeks. Let's see if volatility decreases once again, gets down to that 11 level and below. And as volatility comes down, stocks should continue to go up. So that's my optimistic look at things for today. And if you watch the video I sent out this morning that I did before the market opened, I was pretty adamant about yesterday probably being a one-day event and a market reaction, but not an overreaction, and just an unwinding, a profit-taking turn after the stocks have been straight up. So we'll see if we can follow through and go back up and fill in this gap up above in the S&P. And if it does that, then it's just like we've seen many times before, just that little bit of a shakeup. But try to pick the top. That's not something I'm going to do. We'll look to see where we are on a weekly basis. I think the S&P is down 25 points on the week, but 25 points, what is that, 1%? That's not a big deal. That's not, even when the market was so-called crushed yesterday, where were we down? 2%, 1.75%. So, that fear factor, I think, is more psychological than many other things. So that's what I want to finish with here today. That I still remain positive. I still remain optimistic on the upside until proven otherwise. And for those of you been longtime listeners and subscribers, that's what's gotten us where we are. Successful last year, 41 out of 50 trades, high probability trades and good success rates. So for this year, we got a number of positions in the portfolio that we're looking for the stock market to continue, that in those positions are going to benefit from that. So we're just going to keep doing what we're doing. If you have any questions, send them to Alan@bullseyeoptions.com. Alan Nuckman, I'm sorry, at bullseyeoptions.com. Be happy to answer them. But just want to wish you well, and we'll keep doing what we're doing. I'll send out an update about, there's nothing to be done with the 2 May option positions that are expiring tomorrow. The put that we sold expires, and we could keep that premium. That's what we want. And the covered call that we sold on GoPro expires worthless. We get to keep that premium. That's what we want. And we'll write another one next month to keep that wheel in motion, and then we'll lower our cost basis until we get called out. So that's the rundown. I want to thank you for your time, and we will talk soon. Thank you very much. Good night.